Welcome to Clever Money Hacks, the channel where money moves and life improves. In today's episode, we'll be discussing the hidden financial tectonic plates. You know, the ones shifting right beneath our feet, triggered by some recent geopolitical tensions.
Yeah, we're doing a deep dive into some source material from Mark Moss, and it's a fascinating look at, well, the plumbing of the global financial system.
The plumbing. I like that word. It gets past the headlines.
Exactly, and I think we really have to emphasize that word, plumbing. We're going to try and look past the flashing neon signs. You know, the conflict, the war, the political talk.
And focus on the pipes.
The pipes that move capital around the world, because when access to the global money system suddenly becomes conditional, capital,
Yeah,
well, it doesn't just stop moving.
it reroutes.
It reroutes.
And that idea of rerouting is really the core of our mission today, isn't it? We want to explore how these specific sanctions are accelerating a chain reaction that, well, it challenges the U.S. dollar's dominance.
Yeah, the source argues we're seeing the creation of a whole parallel financial system, and it involves gold.
Right. But we should be super clear up front for everyone listening. This is not about going back to, like, the 1800s and paying for your coffee with gold dust.
Not at all. We're not talking about cowboys and saloons here. This is a highly sophisticated digital reimagining of settlement.
High tech meets hard money.
You got it. But before we get to the solution, the gold part, we have to understand the catalyst. And the source starts right there with the fog of war around the recent tensions between the U.S. and Iran.
And that fog is thick. I mean, looking at the reports, it's just chaos. You have massive protests in Iran, media blackouts where information just stops.
And the numbers are all over the place.
Completely. You've got human rights activists saying, what, between 3,300 and 4,300 casualties. Then Reuters is saying it would be closer to 5,000. It's just a tragic, chaotic situation.
It is, and the human cost is always the first reality. But the source pivots pretty quickly from that tragedy to the macro implications. For us, trying to understand the financial landscape, the key piece here isn't just the military threats, it's the economic weaponization, the U.S. response. A threat of a 25% tariff.
Right.
Which, on the surface, sounds like pretty standard trade war talk. We've heard about tariffs for years now. It almost feels like background noise.
It does, but you have to look at the fine print. The scope here was fundamentally different. It wasn't just a tariff on Iranian goods.
It was on any country trading with Iran.
Exactly. It's a secondary sanction. And it casts this massive net. It's not just shooting at the target. It's shooting at anyone standing next to the target.
Right, because Iran isn't in a vacuum. They have major trading partners who need their oil.
Primarily China. China buys a huge amount of Iranian oil, often through what the source calls these backdoor deals, to get around existing sanctions.
So when the U.S. threatens tariffs on anyone trading with Iran, they're really pointing the gun at China's economy.
You got it. And of course, China retaliated. They opposed the sanctions to protect their energy security. So what starts as this regional conflict, it instantly becomes a power struggle between the U.S., China, and Russia. And this is where we need to look at the mechanism of that power. Like, why does a U.S. threat matter so much? The source uses this really great analogy.
The Visa and MasterCard analogy, I think it's just so clear. Think of the U.S. dollar system, specifically the SWIFT network, as the world's credit card processor.
Right. SWIFT is just the messaging system for banks. It's like the email of money.
Essentially, yes.
Yeah.
It's the rails that money travels on. Now, imagine you're a small business owner. If Visa suddenly bans you, that's a crisis.
You can't accept payments.
Right. But do you just close up shop and say, oh, well, guess I'll starve? No. You scramble. You find a new payment processor. You take cash, you use crypto, you do whatever it takes.
But for the last 50 years, there wasn't another processor. The dollar was the only game in town. If you were kicked off the dollar network...
You were isolated. Exactly. You were effectively kicked out of the global economy.
That was the whole point.
It was. But the argument here is that by weaponizing the network, by telling sovereign nations who they can and cannot trade with, the U.S. is kind of accidentally forcing those nations to build a competitor to Visa.
We're incentivizing them to build their own system.
Out of basic survival. It leads us right into this exodus from the dollar. The source keeps coming back to one word over and over.
Trust.
Trust. It's the currency of currencies. The dollar's dominance wasn't just about military might. It was about being the world's most trusted collateral. It was about property rights.
The deal was, if you park your country's savings in U.S. treasuries, they're safe. Your money is your money.
Even if we disagree. But the source points to a specific moment where that story just broke. The seizure of Russian bank accounts after the invasion of Ukraine.
That was the psychological break.
That was the moment the music stopped. The source argues that when the world saw a nuclear superpower have its assets frozen, it put every other nation on notice.
The thinking became, if they can take Russia's money, they can definitely take ours.
And it changes the whole risk calculation. Capital runs from uncertainty. The source even mentions Iranian elites immediately started moving millions out of the country. But anecdotes aside, what does the hard data say?
Yeah, is the dollar actually losing ground, or is this just, fear-mongering?
The data really supports this withering away thesis.
Yeah.
And it's happening fast. If you look at the trend lines, they're stark. In 2015, the U.S. dollar made up about 60% of global central bank reserves.
60%.
Today, just a decade later, it's dropped to around 40%.
Wait, a 20% drop in 10 years? That seems incredibly fast for something as, slow as global finance.
It's historically unprecedented speed. And it's not just reserves. Look at trade invoicing. The currency used to write the bill for goods.
Oh.
Only 40% of global trade is now invoiced in dollars. The bond market share, it dropped from 50% to 30% by 2024. The actual architecture is shifting under our feet.
All right, I have to play devil's advocate for a second. The source does mention a counterpoint, which is that the dollar is still totally dominant in foreign exchange markets. FX.
It is. 88%.
88%. That still sounds like dominance to me.
And that's a really vital distinction, so we don't mislead anyone. The dollar is absolutely still the king of liquidity. If you want to swap Thai baht for Brazilian real, you probably go through the dollar to do it.
It's the easiest path.
Right. But the structural plumbing, the savings accounts of nations, the invoices for physical goods, that is what's eroding. Nations are actively trying to de-risk their balance sheets. They might use the dollar for a quick swap, but they don't want to hold it anymore.
That makes perfect sense. It's like using a hotel for a night versus buying a house. They're checking out of the hotel.
Good way to put it.
So if they are leaving the dollar Visa network, where are they going? I mean, the media loves to talk about BRICS. Is that the new network?
The source is actually very skeptical about a unified BRICS currency, and it comes back to that same issue again. Trust. I mean, these countries are not best friends. They're frenemies at best.
Right.
The source points out this one detail that's, well, it's hilarious, but also very telling. Vladimir Putin couldn't even attend the recent BRICS summit in South Africa.
Why not?
Because South Africa is a signatory to the International Criminal Court, and he might have been arrested for war crimes.
Wow. Okay, that's a pretty big barrier to opening a joint checking account. Let's pool our money, but if you show up, I have to arrest you.
Exactly. It just shows you how absurd a unified currency for BRICS is right now. You can't do that without deep political trust. So a BRICS euro is probably not happening.
So what's the real contender?
The source says we need to pay very close attention to something called Project Enbridge.
Enbridge. Okay, sounds like a tech startup.
In a way it is, but for central banks. It's a central bank digital currency platform, a CBDC bridge. It lets central banks swap their digital currencies directly.
Without going through the U.S. dollar system?
No U.S. intermediary, no SWIFT, no one in Washington can see the transaction or stop it.
So China wants to buy oil from the UAE. They just swap digital yuan for digital dirham instantly.
Precisely. And the growth here is just wild. Transaction volume surged to $55 billion. That's a 2,500% increase since 2022.
That's exponential. But who runs it? I mean, who controls this new highway?
Well, effectively, China does. The digital yuan accounts for about 95% of the liquidity on the platform.
So it's a Chinese-led system.
It is. And something really significant just happened. The Bank of International Settlements, the BIS, the Central Bank of Central Banks, they actually left the project.
The BIS walked away. What does that mean?
The source implies they basically handed the keys over to these nations and said, you guys run with it. It signifies a formal split. The West is washing its hands of it, leaving China and its partners to build this parallel rail on their own.
Oh, wait, doesn't that just bring us right back to the trust issue? The source says nations don't want to hold Chinese yuan. China has closed capital markets. You can't just get your money out whenever you want. Why would any country trade U.S. dollar dependence for Chinese yuan dependence? That's just jumping out of the frying pan and into the fire.
You absolutely nailed it. That is the fatal flaw of Enbridge, if it relies only on the yuan. You don't want your national wealth parked in a system where the CCP can decide your money is theirs.
So you need a neutral asset. Something that isn't American, but also isn't Chinese. Something nobody can print and nobody can freeze.
And this is the aha moment of the entire deep dive. The solution isn't a new paper currency. It isn't crypto. Not really. It's the oldest money in the world.
Gold.
Gold. And the source is really clear here. They are not using gold as money to go buy things. We're not talking about ships filled with treasure chests.
No, no. They're using gold as neutral settlement collateral. Think of it as the poker chips on the table. Gold is fungible, it's physical, and most importantly, it requires no one's permission.
It's a bearer asset, no counterparty risk. Exactly. If you have the gold, you have the value. And China has been preparing for this. The source mentions they've been mining and buying massive amounts, maybe 20, 30,000 tons.
An insane amount of metal.
But the real insight isn't the hoarding. It's the infrastructure they're building, a complete industrial chain for gold settlement.
Okay, let's unpack that. The source talks about a new ecosystem between Hong Kong and Shenzhen.
It's very strategic. Hong Kong is the financial interface to the world. It has the banking, the rule of law. Shenzhen and Shanghai are the industrial engines. So they've expanded the precious metals depository in Hong Kong, and the Shanghai Gold Exchange set up an offshore warehouse there.
They're linking the financial hub with the industrial hub, creating a gold-backed settlement corridor.
You've got it. It allows nations to trade with China, settle the difference in gold held in Hong Kong, and never touch the US dollar. And this is not just a theory. The source says swap lines are open with 32 countries.
And that list of countries is startling. I mean, you expect to see Russia and Brazil.
The usual suspects.
Right. But then the source highlights U.S. allies. Japan, Canada, Switzerland, Saudi Arabia.
Japan and Canada. That's what made me stop and reread that section. These are G7 nations, staunch U.S. allies.
So why would they get involved in a Chinese-led gold system? It feels like a betrayal.
I think it shows this isn't purely political, it's pragmatic. These countries need to trade, they need options, they want a backup generator in case the dollar grid goes down.
They're hedging their bets.
100%. It also legitimizes the system. If it were just Iran and Russia, you could dismiss it, but when Switzerland and Japan join the chat,
it becomes a credible alternative. And there's one country notably absent from that list of 32.
the United States.
We're on the outside looking in.
Yeah.
Okay, so let's zoom out. What does this all mean for the person listening right now? What is the so what?
The source makes a critical distinction here that really brings it home. These nations aren't trying to replace the dollar in your pocket. The cash.
They're trying to replace U.S. treasuries.
The savings account in the world. For decades, the deal was simple. The U.S. buys stuff from the world, and the world takes those dollars and buys our government debt. That's what allowed the U.S. government to run massive deficits.
There was always a buyer for our debt.
Right. But if nations start using gold as their main reserve asset,
They stop buying our debt. That loop breaks.
they buy gold instead of treasuries. And if they stop buying the debt, but the government keeps spending, who buys it?
The Federal Reserve.
Which means printing money. And this leads to what the source calls the debasement trade.
This is where that Larry Lepard chart comes in. Can you paint a picture of that for us?
It's a recurring pattern. You see the trend line of the Fed's balance sheet. And every time the system starts to creak, a bank fails, a market freezes, something blows up,
And the Fed is forced to step in.
and print massive amounts of money to patch the hole. The supply of dollars goes up, and basic economics says the value of each dollar goes down.
That's debasement.
Right. So the actionable insight from the source is pretty direct. Traditional assets, stocks, bonds, treasuries, they are all denominated in dollars.
So the stock market might hit a record high.
But your grocery bill is doubled. You're not actually richer, your currency is just weaker. So the source suggests moving to assets that, quote, don't depend on permission.
Gold and Bitcoin.
Gold and Bitcoin. He specifically says the recent all-time highs in gold aren't just because people are scared, it's because gold is being remonetized as the collateral for this new global trade network.
That is a huge shift in mindset. It's not just jewelry demand, it's structural demand from central banks.
Structural demand is the most powerful kind. It's price insensitive. If China needs gold to settle trade, they're going to buy the gold, period. They need it for the plumbing to work.
So we're witnessing a fundamental repricing of the world's financial system. The volatility we see isn't just noise, it's the sound of the gears shifting.
That's a great way to put it. And it raises a final provocative thought. You know, we always talk about the cost of switching away from the dollar. It was just too high, too difficult.
It was easier to just stay with Visa, even with the high fees.
Right. But with the aggressive use of sanctions, the U.S. has inadvertently raised the cost of staying. If staying means your assets might be frozen, Suddenly, the cost of switching doesn't look so high anymore.
It looks like an insurance policy, and once you build that new highway, you don't just tear it down.
No. Once nations leave and they've built this new infrastructure, they likely won't come back.
Uh,
We could be looking at a permanent split in the global financial system. Two distinct tracks.
a heavy thought to chew on. The world is changing, and the money is moving differently.
It certainly is.
Well, that brings us to the end of this deep dive. Thank you for listening to today's episode, and don't forget to like, subscribe, and share your ideas for future episodes. See you next time.